A Wealth of Advice is an open exploration of ideas and actionable advice with the goal of helping you to achieve your personal aspirations. The team at Cathmere Capital and their guests strive to deliver thoughtful insights on how to manage your wealth, realize successes in your career, and live a healthy, personally fulfilling life.
Hi, thanks for joining us on A Wealth of Advice. My name is Nicholas Olesen, and today you're going to hear an interview that we did with Perth Tolle. We thought the timing of this was really perfect. We have a video version of this, but we wanted to put this out on the podcast as well, as we believe that you'll get a lot of benefit from it. To give you the background on Perth before we get into the interview, Perth Tolle is the founder of Life and Liberty Indexes and creator of the Freedom 100 EM Index, or FRDM Index. Prior to forming Life and Liberty Indexes, Perth was a private wealth advisor at Fidelity Investments in Los Angeles and Houston. Prior to Fidelity, Perth lived and worked in Beijing and Hong Kong, as you'll hear, which is where her observations led her to explore the relationship between freedom and markets. Perth is a frequent speaker at investment industry events and provides commentary for basically every financial media company you can imagine. She's recently been on Bloomberg, CNBC. She's been in the Wall Street Journal, Morningstar, you name it, she's been on it. She was also named one of the 10 to watch in 2020 by Wealth Management Magazine and one of the 100 people transforming business by Business Insider in 2021. And now, on to our interview. Hi, thanks for joining us on A Wealth of Advice. My name is Nicholas Olesen, Director of Private Wealth at Cathmere Capital.
And I'm Nick Ryder, the Chief Investment Officer here at Cathmere Capital.
So today we have a really special guest. We've wanted to get her on for a while, and with all the news going on, I know she's had a lot of news inquiries and a lot of different times that you've probably seen her out there, but we have Perth Tolle on with us. So Perth, thanks for joining us today.
Thanks for having me. It's a pleasure to be here.
Yeah, so we wanted to get you on. As we'll talk about more, and please listen to the disclosures at the end, everybody, because we are investing in a strategy that Perth is overseeing and came up with. And so we really wanted to dive first into this and really go through the emerging market side of investing. With everything going on, we're recording this in March of 2022. With the tragic events in Ukraine and Russia, it has been on the forefront of everybody's mind. And so Perth and I actually had been chatting of all things via Twitter. And I let her know just how important it's been for our clients to know that their allocations, their strategies actually take a focus that's away from just the world in general and kind of takes what you'll find out, a freedom element to it. So I just want to kick off there, Perth, and just say thanks for coming on and start off with kind of question number one is how did this strategy come about? Tell me the history for yourself of kind of building this.
Yeah, so I grew up in both China and the US, and that kind of dual country background gave me a lot of insight into kind of the difference that freedom made, not only in my life, but also in these various markets. I went to Hong Kong after college and lived there for about a year and traveled throughout to Beijing and Shanghai, Shenzhen, other cities in the mainland, and just saw the difference, the huge difference that freedom made on these various countries. So when I came back to the US, I worked at Fidelity as a financial advisor. And I had clients who kind of felt the same way that I did, in that they were from Russia or Saudi Arabia or other places. And they said, I don't want to invest in my home country because I know what's going on there. And my Russian client actually told me it would be like funding terrorism. Very prescient as we see the events from this month. So, in emerging markets, and we, were asset allocators, believed in having a diversified portfolio, including emerging markets, especially now, since it's coming from a very low base with also favorable valuations compared to the US and developed markets, and US and developing so high. So, I wanted that allocation, but I didn't want these market cap weighted strategies, which is all that was out there previously. Because with market capitalization weighting, which in developed markets, there's no problem. It's actually a good way to get a very tradable solution. But in emerging markets, it creates kind of this dictatorship funding monster because it has like 40% in the world's worst autocracies like China, Russia, and Saudi Arabia. Russia is the one that we see as a problem now, but China, Russia has 3% in most of these emerging markets indices. China has 35% right now. It was 45% at their height in August of 2020, and it's declined because of their market decline. but there's still, MSCI is still adding A shares and in process of adding A shares. So that target weight is going to go up to 49% in one country. Jeez. In the emerging markets indices. So that's not very well diversified and just going to be a major risk and huge returns drag going forward in emerging markets. So that's kind of why, we created this. And, to kind of talk a little more on that China aspect of it being the biggest, market cap country and the biggest issue in the emerging markets indices. If you look at MCHI, which is the MSCI China Index, which is onshore and offshore shares, since 1992, the inception of the index, to now, there's a 0% cumulative return. And that's during a time when China grew exponentially in their economy because they opened up from very poor policies before. And now they're reversing all those policies that made them prosperous. And the crackdown on, sectors that used to be their favorite sectors like tech is intensifying. The crackdown on human rights is intensifying. So that's just going to be a major issue in market cap weighted strategies going forward. So China and, my background there was the inspiration for a lot of what I do now. And it was my time in Hong Kong where the seed was planted. So after I left Fidelity, actually to stay home and be a mom for a while, after my kid became old enough to go to school, I became more full-time on this. And we launched the fund based on the product in 2019. The index was incepted in 2017.
Okay. Yeah, one of the things that drew me to the strategy Perth was just that one of our fundamental principles in investing, particularly when you think about long-term exposure, long-only exposure to public equity markets around the world, is that there's a very solid theoretical and economic case for why, as a shareholder and an owner of these companies, I'll be rewarded for providing financial capital in it, right? That's the beauty of the capitalistic machine working in terms of that I provide financial capital to a company and I can rationally expect positive rewards from that. And it's fun. It's you point out so saliently when you look at particularly the issue in emerging markets, and that for many of these systems that personal economic freedoms are not respected. And so it was something that I had always been looking at, which is, hey, I have this belief in why are we going to allocate long-term to equities around the globe. However, drawn to the emerging market side of things, just given the cyclical kind of lag in recent years and the very attractive valuations, but you always had to run the risk that, hey, will I actually have my property rights respected? Will I actually be investing in companies here that are looking to drive profit rather than some other goals, and ultimately, or will those profits even be returned to me as a shareholder? And so I was just so fascinated with the approach period on how you were looking at this.
Yeah, no, that's exactly right. And that's, the perfect example is what China did last year. And you see, again, China's always exhibit A for emerging markets problems. But so they, carpet bombed all their industries. And these are companies that have to put state interests first before the interests of their shareholders or any other stakeholders. So, by investing over there, we are subsidizing the cost to them of doing business that way. And it's not a good way to capture growth at all. So even, that's why even in a period of extreme growth in China, equity investors didn't capture that at all. So we do want to focus on the emerging economies that have the conditions in place to allow their companies to put their own interests, the interests of their shareholders and other stakeholders like customers, before those of the state. And so that's where we think the growth stories of the next decade is going to be found. And we free up a lot of space to invest in those types of countries by not having 35% in the growth story of the past.
How maybe just walk us through a little bit how so you had, I'm assuming, the idea for, hey, there's got to be a better way to gain exposure to emerging markets and we should prioritize freedom. Like maybe walk us through like how you tackled the problem of ultimately leading to the creation of an index upon which a strategy could be built.
Okay, yeah. So when I first came up with this idea, there wasn't really a quantified metric of human freedom, which is the combination of both personal and economic freedom.
Right.
There was economic freedom. There were economic freedom metrics that were quantified, but not personal freedoms. So personal freedoms are what I consider like civil and political freedoms, like terrorism, trafficking, torture, freedom of speech, media expression, civil procedure, criminal procedure, things like that. Economic freedoms are like taxation, business regulations, rule of law, private property rights, as you mentioned, investor protections, sound money, freedom to trade internationally, and so forth. So one side didn't have any quantitative metrics at all. There were a lot of qualitative metrics, like reports you could read and things like that. Right. So I had to develop a strategy with help of quantifying those metrics that were qualitative. So we developed our own system of doing that called the Human Rights Quotient, and there was a provisional patent on that system. And then when I got ready to start this as an actual index, I went to start scoring countries using that system. And when I did, I went to the economic freedom source, Fraser Institute, and to get the economic freedom numbers for the inputs. And I noticed that on their website, they had something now called the human freedom index and data set. And I was like, what is that? And so I called Fred, my contact at Fraser, and I was like, Fred, what is this? And we compared notes, and our two systems were like, they basically added personal freedoms to the economic freedom side. Wow. in conjunction with Cato and a German think tank and Friedrich Naumann Foundation, who is now no longer working on it. So now it's just Fraser and Cato. But they basically quantified the whole thing. And I was like, this is fantastic. Can I just use this instead? And that gives me third-party objectivity, because when I'm scoring the countries myself, I have the ability, not that I would, but I could influence those scores. Sure. But now when an independent third party is doing the scoring, I have no ability to influence those scores. And that's much better in the case of an investment product to have that third-party objectivity. And it works both ways. They can't influence us in any way and vice versa. So, and these are think tanks that do not take any government grants from any government, not even the United States and Canada, which is where they're located. So they have that quantitative score per country, including, they have 79 different variables, which they compile, encompassing personal and economic freedoms. And then that comes with a composite score per country. And that is my input into our freedom weighting system. With that, we derive the country weights and allocations.
Interesting. So when you look at, let's go through kind of what most people who are listening to this and have experience on the investing side. You touched on it on, China being so large. I think that's the one that's most surprising when you talk about emerging markets. One, some people are actually surprised that China is an emerging market. And others are just shocked when we actually go through MSCI, which is an index provider, just the weighting of it. So tell us the story of kind of where it was. And I know performance is part of the reason. The A-share one, I think, is an interesting one that a lot of people have not understood about the differences of what their share classes are and then what that is going to become. So can you walk us through right now what you mentioned China? Let's talk through kind of ones that have been excluded for not having good scores. And obviously with everything going on in Ukraine and Russia, we know one. But can you give us kind of I'd say the bad three, if you will, and what their weightings are and what they're out?
Yeah, so the top excluded countries are China, Russia, and Saudi Arabia. So that was obviously before this all happened with Russia. Now there's no Russia in any index because it was just written off. So China, Russia, and Saudi Arabia were in the top 10 of most emerging markets funds. So right now it's China and Saudi Arabia in the top 10. Other exclusions that are smaller in the cap-weighted indexes are Egypt, Turkey, UAE, Qatar, so on and so forth. So those are the smaller kind of exclusions, but China, Russia, and Saudi Arabia are the top three.
Hey, Perth, one of the things that I remember from some of our early conversations on this, and where a lot of the impetus was on this, even kind of kicking off our conversations was the China issue. And I sat back and two of our fundamental beliefs are one on just kind of the benefits of capitalism in the long run in driving returns for securities markets investors. The other side of it being that markets generally do a pretty good job setting prices and allocating capital in that such that, we should always be a little bit humble about our ability to identify things that are dramatically overvalued or undervalued. And so I always had in my mind this view that something doesn't feel right with China, It's very much kind of, it's central government heavy and driven from a top down, and you could have rightful concerns about the willingness of companies to drive returns for shareholders or return profits to shareholders. But I also always sat back and said, all right, what unique insight do I bring to the table here, or what makes me so sure that the rest of the world hasn't realized this? And I remember you had some interesting thoughts on why basically, right, China could still theoretically be very well overvalued from the perspective of an investor, despite all these things that we know, and the fact that markets are generally pretty darn competitive and do a generally pretty good job at setting prices such that there are no free lunches.
Yeah, no, this is something I actually struggled with in the beginning, because I was like, is this really going to work? Because, it shouldn't already be priced in. Like the risk should already be priced in. Freedom should already be priced in. But what I did not account for is that people mispriced the risk. So we overestimated the China model, for example, and we underestimated the autocracy risk. Same thing with Russia. And with Russia, we see the effects of that much more clearly now. With China, we're seeing the effects of that as well. I mean, there are certain days. I mean, China is starting to trade like a meme stock right now, or sometimes, some days, or like a coin. But that's not real. That's not real market action. That's it's if everything in your market is based on what the regulator says that day, regardless of what they might actually be doing. It's all based on government action, which is extremely capricious and unpredictable and unquantifiable. It breaks the discount model. So, we don't think that we want to be exposed to that type of tail risk. Neither would our clients. So we would prefer to be in markets where you can kind of price in things in a more predictable manner. Not that we can ever predict anything, but just with things that you can actually calculate, not risks that are completely incalculable.
Yeah. And that was one that I think is touched on a lot of client interactions that we've had. As we've said, we utilize this strategy for our clients in our emerging markets allocation, depending on the client, depends on how much they have of it. And with everything going on, over the last month and a half, it has been one that has resonated that, okay, this was my fear of emerging markets, or this was my concern with it. And I think by you going through and actually quantifying, I love the qualitative signs that we all think and feel, and then being able to have a third party with the quantitative side to come through. How have you seen that as kind of what historical data has shown by excluding these? I know the index is 2017 from what I recall. What is that shown as far as either, the discrepancy between them? And this isn't looking at past returns and saying, hey, this is what's going to happen in the future, but just kind of when you look at it in the investment thesis of it, I'd love to know kind of what you've seen there.
Yeah. So our thesis was that freer countries would have more sustainable growth. They would recover faster from drawdowns, and they would use their capital and labor more efficiently. So there's less capital flight and capital destruction. And that can be capital destruction of economic capital, like we see, with the volatility in China, or it could be destruction of human capital, like, one-child policy.
Right.
So those were our three main theses. And then one of my advisors also said, well, I think that you'll experience lower drawdowns as well. And I in the beginning disagreed with that. And I was like, well, that's because you're looking at, just, 1 year or whatever. But now we've seen that as well. So so that I think we've had a very extreme market environment over the past couple of years when this fund has been around. And so we've seen a lot of good live history. And if you zoom in on certain parts of it, there are you can see exactly where we outperform and where we underperform. So we underperformed when China outperformed right after COVID. And then we outperformed the recovery drastically, better than, broad emerging markets also outperformed emerging markets ex-China. So it wasn't just China, also outperformed emerging markets ESG. And then you'll see in this year, the drawdown in Russia, obviously we didn't have any effect on us. And so we did have a lower drawdown, like my guy had predicted that we would. So I was like, okay. And then if you look at the index history, it does tell the same story. though less dramatically, because I think in the past, 3 years or so since this fund has been around, the market environment has been very extreme. So
Yeah.
the current outperformance is very stark. And I am, obviously happy about that, but obviously we don't guarantee future performance.
Right.
So what
right.
we do guarantee is that we will keep those worst autocracies out of your emerging markets exposure. So you'll never be, funding those dictatorships with your allocation.
Yeah.
Yeah.
So maybe just actually pull it up a level and just walk through kind of how the index is constructed. We start with the 26 or so countries in the broader EM universe, and maybe kind of take it from there and how ultimately the index is constructed and what's included in there.
Yeah. So first we start with the MSCI universe. Actually, we're not bound to that, but we do use that as that's typically pretty standard. So it's 27 countries to start, and then we get it down to 18 countries that are in the eligible universe, because there's some countries that are too small to trade or too illiquid. Like Czech Republic is very free, but it's just not big enough to be in this product. So then we have about 18 countries left, and we freedom weight those countries. It's 100% freedom weighted. So it's not a tilt, it's not an overlay. And we're using those quantitative metrics from the third-party think tanks, putting them through our freedom weighting methodology and coming out with the country weights. Those country weights drive security weights. So it's a top-down approach. Once we have the country weights in place, and again, as a natural result of that process, the worst autocracies are excluded. I don't draw a line in the sand. It's relative to its peers. So anything that is freer than their peers, relatively speaking, then they are included. Anything that is less free than their peers, they're excluded. So it's kind of like an above the average situation.
Yep. How have that, I'm curious, just been trending in recent years, or as long as you've been looking at it? Or is that the EM block becoming more free, less free, or even just relative to the rest of the developed world too? Like, what are you seeing on a macro level there?
So there are some countries, there are some shifts, but what I'm seeing is like, for example, in Poland, very extreme right-wing government got voted in place in like 2016. Yep. The Polish delegate from the think tank network told me, hey, it's going to get kind of crazy. We're going to lose a lot of freedom, like judicial independence, things like that. They're going to get constitutional majority, but it won't show up in markets for a couple of years. And it happened just as he said. Policies typically don't affect reality for a couple of years, or it's not reflected in scores for a couple of years also. So Poland actually went from number 1 holding to number 4 in 2018. They were still the top performing emerging market in 2017 when they were our top holding. And then they actually went to number 4 in the index after that. But what we've also noticed is that in freedom declines happen a lot faster than freedom increases. So increases very gradual. And we haven't actually seen a lot of increase just in the few years that we've been doing this. We've seen a lot of declines, and but that's just a couple of years. And it's kind of like the stock market, like, the economy goes up in, or the trend for the stock market is up overall, but in the short term, you can have, a lot of volatility. And so same thing with freedom. The trend from, if you look at history, is definitely going toward more freedom. It used to be, the world used to be a lot more autocratic, a lot more, there used to be a lot more repression. Now there's a lot more freedom, a lot more democracy and so forth. But in the short term, it could still be a downtrend. So right now I'm seeing a downtrend in the short term. And so we do have, speaking of downtrends, we have a freedom decline momentum rule, right? That's like a stop loss in the methodology, that if a country declines too quickly on any given scale that we use during the time period of 1 year, the preceding year of the rebalance, then that country is excluded at the time of the rebalance, even if it's included previously. And the only country that's ever triggered that was Turkey in 2018. So before the fund, it was just the index. Okay. And since the fund launched, there has been no country that triggered that rule, just because Turkey's just declined very quickly in 2017.
Okay. Fascinating. Interesting. When you look at it from the investor side and having talked to so many advisors and those that are kind of allocating capital and utilizing the strategy, what else have you heard as far as just feedback that they've gotten and just kind of why they choose to utilize this strategy? Obviously, we do. We know why we do. But what else do you kind of hear out there from individuals besides kind of what we've talked about so far?
Yeah, and mostly investors invest in this for two reasons. One, it aligns with their values. So I hear from some impact investors, ESG investors, and so forth. And then two, they expect it to outperform. I think you guys are in that group. So those are the two types of investors that we typically get. I think recently with Russia, so in the last couple of years, I've seen mostly the second group. But recently with Russia being on the forefront of conversation, people are seeing country level governance as maybe a new type of ESG
Sure.
metric. And I actually agree with that. I think once you have the country level freedom conditions in place, then you can talk other ESG. It's the basis for all other ESG. I mean, you can't have ESG if your metrics are from a country where there's no independent verification of those metrics. So there's no free speech or free expression or free media. You know, your metrics are completely self-reported and you know, government ordained or whatever. It's not reliable for determining the impact of your investments. So, so once you have basic freedoms, then you can talk about other ESG. So I think that is a good trend that is happening. Also, what we found is once you have the G in place on the country level, the E and the S typically follow. Yeah. So, you know, you asked about, you know, benefits of freedom, I think earlier, and a lot of those benefits are, you know, well documented, but they're less tangible. So things like, you know, freer countries have higher life expectancy, lower infant mortality, higher gender equality, lower poverty rates, higher income per capita, lower corruption, and higher GDP growth. And all of that is all very like hard to visualize for people, but in the form of the FRDM index, we're providing hopefully a running scorecard for freedom so that people can see, okay, there are benefits to freedom in countries. So that's what we're trying to provide as well.
So I cut you off on index construction. It was 27 countries down to 9 or 10 based on the relative freedom score. Then what goes from there?
So it's 27 in the universe, 18 in the eligible universe, based on, you know, whatever's tradable enough to be in there. We end up with 11 this year. So previously we've ended up with 10, but remember, I don't draw the line. The methodology does that. So we had 11 included this year. And, you know, the bottom country that was added was Thailand, which is a military, somewhat of a dictatorship. And so that's a good example of, hey, you know, in emerging markets, there's, especially in anything, but especially emerging markets, there's no 100% free country and there's no 100% repressive country. It's all relative. So if Thailand was higher than average of the scores in their ranking this year, they're going to be included. It was a 2% weight, but it's included. So it's a relative you know, weighting methodology, and we take the relative rank to their peers. So once we have those country weights, then we look at the security level. And on the security level, we're just trying to capture a good representation of each of these countries' markets in a very tradable way. So we're taking the 10 largest, most liquid securities within each market, excluding state-owned enterprises. And that's just to bring the economic freedom theme all the way through. So the less government interference in private business, the better.
Okay.
And those are market cap weighted within their freedom weighted country weights. So it does not affect the country weight in that weighting.
Okay.
Great. Yeah. I think we want to be sensitive to your time. I know that I'm sure someone else is waiting around to talk through everything, but the only other one that I wanted was more just kind of an outlook for the next 5 years. I know that's not something I'm not asking for performance. I'm asking more on the freedom side of it, as that's what our desire for the index and our desire and utilization of it is believing in capitalism, and then also just the freedom side. Like if you fast forward 5 years from now and you look back and say that was a really successful 5 years, you know, on the index side, and what you see as kind of what this then allows investors to talk about or conversations to have, what would you look back 5 years from now and say, this was because of creating this, X, Y, or Z has changed? What would that look like?
You know what, I guess, I mean, I understand your question. It's not an outlook. It's for, you know, what it looks like for what maybe we contributed to the conversation. I think I came into this with no expectations because, I wanted to make this product exist no matter what. I didn't care if it was going to fail or no one was going to invest in it. I was like, this has to exist. So I'm extremely pleased with what I've seen as far as the way that people have responded to it and the joy that we brought to clients and given people a story that they can tell and be proud of in the way that they're investing. And so I'm extremely hopeful for this conversation in the next 5 years. And I would have never thought that freedom would have, that this thesis would have played out this quickly, not in a million years. I mean, we've only been around for just under 3 years. I thought it would take decades. So I'm very, very pleasantly surprised by what has happened already, that, when Russia invaded Ukraine, tragic situation, but people's eyes were opened to the autocracy risk. And, as you mentioned, the media has just been all over this, and the investment media. And so I think this is becoming a conversation now where people are saying, hey, it's not enough, what we're looking at for metrics. We have to, calculate for this risk and better than we have been in the past. And this is real. And investors are feeling it. They felt it last year with those China stocks. They felt it this year with Russia. So investors are going to start asking questions. And, retail investors and independent advisors like yourselves are typically the cutting edge, typically the first to market with new strategies like this. So, congratulations to you guys finding this for your clients, being one of the first ones. And so, and then institutions very slowly follow, right?
Yeah.
So we've had, and now we're starting to have interest from institutions. And then very slowly, even slower from that is Europe. US tends to be a little more innovative, and then Europe follows. And so we're getting interest from Europe now. So that's what I'm seeing, is that this trend, we're very happy to start this conversation. And I hope that more people think about investing this way, and we'll do all we can to keep getting the story out there.
Yeah. Well, we obviously are fans of it. We're very thankful that you built this, and the FRDM strategy is just, it's one that makes sense both on paper, and then obviously to see it play out as quickly as it has, and to have clients understand that their capital is behind a freedom waiting has been just a joy, frankly. So we thank you for your time and bringing this to market and putting, I know, a lot of blood, sweat, and tears into this.
No, thank you so much for investing. And I'm very honored to call you guys investors, and just, investors like you. That's who we created this for. So thank you.
Perfect. Well, thanks, Perth. This was great.
Thanks, Perth.
The views expressed on this podcast are the personal views of the participants as of the date indicated and do not necessarily reflect the views of Cathmere Capital Management itself. Nothing contained in this podcast constitutes investment, legal, tax, or other advice, and it should not be viewed as a current or past recommendation to buy or sell any securities or to adopt any investment strategy. The information discussed on this podcast was general in nature and is not designed to address your individual investment objectives, financial situation, or particular needs. Prior to making any investment decision, you should assess or seek advice from a professional regarding whether any particular transaction is relevant or appropriate to your individual circumstances. Although taken from reliable sources, neither Cathmere Capital Management nor the participants on this podcast can guarantee the accuracy of the information received and discussed from third parties. The information discussed is current as of the date of this podcast and is subject to change at any time based on market and other conditions. As a reminder, past performance is no guarantee of future results.